guy. We have a lot of fun with him. His segment on my show is called Financials, Adam's Financials, and that's because he really tries to bring a lot of, light and energy and entertainment into the subject matter. So, Adam, thank you for being with us today. This is your first Lunch and Learn, so we're real excited to have you here. So, welcome, Adam.
Thank you, Toni. Toni's a wonderful person to be doing a radio show with, and it's very kind of her to invite me here to talk to all of you. And thanks so much for coming along. I'll get started then with my with what I call Starbucks economics and the route to great wealth. Okay, so I'm going to tell you a little story about my friend Spendthrift Sam, who never saw a Ferrari that he didn't want to make a lease payment on. Young advertising executive, incredibly handsome, really cool. And the chicks dig him, and he takes them out to the highest caliber restaurants, takes them back to his totally tricked out apartment, and he's got it all covered, except for one thing. Every day he goes to Starbucks, and he puts Starbucks $5 a day onto his credit card. And it goes onto his credit card day after day, week after week, month after month, year after year, and that's the one little thing he doesn't quite pay off. And it accrues at 7% interest. It's kind of amazing. Someone kind of crazy has given him a low interest rate credit card, because 7% is pretty good. But hey, no worries. It's only about $1,500, $1,600 a year. What's the big deal? Meanwhile, Spendthrift has a sister called Sensible Susie, who is a CPA. And she lives by Samuel Johnson's credo. Samuel Johnson was an old British guy about 300 years ago, who said, the difference between a penny a day saved and a penny a day owed is a lifetime of happiness versus a lifetime of misery. Okay? So Susie, the CPA, lives by that, and she tries to save. So every time she loves Starbucks too, but every time she doesn't go to Starbucks, she puts $5 in this Perspex cookie jar, okay? And she starts what she calls the cookie jar game. So it's right there up on her kitchen counter, so she can see it grow. And as she resists, she puts it in, and it gets kind of exciting seeing those dollar bills grow in the cookie jar, and that gives her more energy to try to resist going to Starbucks. In fact, she gets so much energy out of it that when she chooses the cheaper entree at a restaurant, she'll rush home and put $10 or whatever she saved into the cookie jar. And some days she goes to Starbucks, and some days she saves on the entree, but overall she is saving $5 a day. When the cookie jar gets full, she puts in a special savings account, she calls it her cookie jar savings account, and she invests it at 7% a year. Now I must say, 7% cannot be guaranteed, and investments go up and down and all the rest of it, okay? The lawyers think to say that, which is absolutely true, okay? So, but it grows at 7% a year. They do this from the age of 25 to the age of 35. Any guesses how much one is in debt and one has in investments?
Around $45,000 in debt for the guy that did the Starbucks, and then he probably around the same, I guess.
Well, it would be around the same, but it's actually 26,000. But still, good guess. So maybe not quite as exciting as you thought, but still, it's $26,000. So, hey, it's not a fortune that that Sensible Susie has saved, but still, it's a nice little nest egg. And for Sam, it's a nasty little debt, okay? So, but Susie certainly can't retire on $26,000. However, if Susie now stops saving, just from the interest alone, ironically, her savings are now going, her investments are now going to accrue. If they're accruing at 7% a year, they're going to accrue at $5 a day. So now her investment is growing, and she can start going to Starbucks, okay? Meanwhile, Spendthrift Sam, if he wants to just keep level with Susie as Susie stops saving, he's now got to save $10 a day. He's got to save $5 to pay his own interest and $5 to keep up with her, okay? So he's got to stop going to Starbucks and find something else to cut. Now, if Susie, oh, by the way, if he decides to try and close the gap on Susie, it's going to cost him $20 a day, and it's going to take him 10 years to do it, from the age of 35 to the age of 45. Okay, he is going to be having to cut down on not just Starbucks, but going to restaurants and everything, and finding cheaper girls to take on dates. So now, however, Susie keeps saving. Okay, so she keeps going with her $5 a day. On top of that, she increases her $5 a day by 3% a year. In fact, from the age of 25 to the age of 65, she increases her savings by just 3% a year as her salary goes up or inflation goes up. Any guesses as to how much she has at age 65? She has around $600,000. Okay? Now that you can start retiring with. Now, because she's sensible, she married Sensible Simon, a fellow CPA, and he has just the same saving habits as she does. So of course he has also saved $600,000. So now they have $1.2 million just by not going to Starbucks and saving $5 a day. Meanwhile, sexy spendthrift Sam has married stripper Sally, who had exactly the same spending habits as him. And guess what? She is also $600,000 in debt, and together they're $1.2 million in debt at age 65. So they won't be retiring anytime soon or ever. So guess who's sexy now? Okay, so that's my theory of Starbucks economics. So, and I do find it useful. You know, it's so difficult for people to save, and there are various ways of doing it. And obviously one of the main ones that people talk about is saving a little bit of your paycheck every month before you ever get it. So it's automatic, and that helps you save. But I do find it kind of fun to put a jar on the counter, if you're not going to get burglarized, and see those dollars grow. And it does. To be honest, I started doing this myself, and it stopped me going to Starbucks. Yeah, exactly. I live by my own medicine. So now this 7% that I blithely throw out there, that Susie gets 7%. How realistic is that? Is there anybody here who has investments and maybe they're with some company and they've been frustrated that they had them for a period of time and they didn't seem to grow, or they went up and down and ended up where they started? Anybody had that experience? Okay. So 7% is thrown around by the investment industry. Even 8%, 9%, 10%, 11%, 12%, as if this is easy to achieve. And I'm sorry, but it's not. Now, why is this? Why does it seem so difficult to achieve? Well, one thing is, they say that the S&P 500 has increased 11.7% a year since 1900. Okay, over 113 years, it has increased, on average, 11.7% a year. That sounds amazing, right? But that's what we call the arithmetic average. Now, the geometric average is something completely different, and I'll explain what geometric average is to you in a second. But I'll give you an arithmetic average. If you have $1,000 and you invest it, and whatever you invested in, the market you invested in, be the housing market or the stock market or whatever, the currency market does incredibly well, and it goes up 100% in 1 year. Okay, so suddenly you have, what did I say, $1,000?
Yeah.
Okay, so suddenly you have $2,000. Okay, and then the next year, suddenly the sky falls in, and your investments go down 50%. Okay, so they went up 100%, down 50%. Well, your arithmetic return has been, you add the two returns together, 100 plus minus 50 is 50. You divide by 2. Your average return was 25% a year. Sounds awesome, right? Anybody would love 25% a year. But what did you experience? You experienced right, you experienced $1,000 here, doubled, went up to $2,000, dropped $2,000, dropped in half, went back to $1,000 again. You experienced no return at all, okay? So, what do we call this? We call this the geometric average. SAT scores are good if you're talking about arithmetic averages, but when one result, $1,000 going to $2,000, affects the next return, we have to call that geometric. So another phrase for this in investment terms, coined by a man called Robert Shiller, is compound annual growth rate. So if you invested $1 in 1900 and you kept that investment till today, what would it be worth? Okay? So the compound annual growth rate since 1900. So let's see, we're doing 11.7 was the average return. The compound growth rate is 9.6. So compound annual growth rates over the long term are generally about 2% lower than the arithmetic average. Okay. Now we have inflation. Okay. So your real return is 6.53 once you take out inflation since 1900. Okay? Now, on top of that, you generally have about 1% in taxes, and you have about 1% in fees and expenses. So you go down to about 4.53. That is ahead of inflation, okay? And just keeping ahead of inflation is significant, okay? It's huge. It's better than putting $1 in your mattress. So, since 1960, when I was born, I was curious to see how things had fared, because it's about 1% lower than that, okay? So it's about 3.5 once you take out, again, that's taking out fees and expenses, taxes and expenses. And since 2000, for those young people here, since 2000, as you know, we've had some up and down markets, and the compound annual growth rate before taking out for any kind of taxes or expenses is 1.7%. Again, net of inflation. Okay, so that is in $2,000 versus today's dollars. If you include inflation, it's more. And I know that you guys, being at Keller Williams, are going to be like, Tony is. Oh, well, we should invest with real estate. Well, I hate to tell you, real estate, according to Robert Shiller in his book, Irrational Exuberance, has done no better, okay? So, however, the good news is, before I depress you all too much, that beating inflation is huge, okay? So, the $1 that, let's say we got Grandma and Grandpa back in 1900, and Grandpa sticks $1 under the mattress, and Grandma invests $1 in somehow in a diversified fund that matches the S&P, okay? So, you inherit Grandpa's dollar, and you inherit Grandma's holdings, okay? Grandma's holdings are going to be $40,000. Her dollar has turned into $40,000. Now, that's not including taxes and expenses. I'm not discounting for that, but that's the compound annual growth rate in today's dollars. That's including inflation, because inflation will be part of that. But either way, the dollar's turned into $40,000, while Grandpa's dollar is still $1. Okay? So it's still worth investing methodically and just holding it over a long period of time. The other thing that should be said is there are times when markets, just like over the last 10 years, they go up and down and they don't seem to get anywhere. That happened from 1966 to 1977. People get frustrated. They cash it in. They buy themselves a new car. My father-in-law bought himself, about 20 years ago, a new truck. A new truck and a boat with his 401k when in his mid-40s, when he left the company he was working for. Well, guess who has no money now? My father-in-law has 0 retirement funds, is living off my mother-in-law. So, when you get frustrated over about 15 years, that's probably just about the time you're about to have liftoff in the markets. Just about the time you're about to have the 80s or the 90s when the markets will go through the roof. So patience is really imperative. Obviously, as you know, both in housing and in the stock and bond markets. So my daughter came to me and said, Daddy, I want to make a lemonade stand. And I need some money. Okay, sweetie, how much money do you need for your lemonade stand? Daddy, I want $100 to buy myself some equipment and a really cool stand that I saw at the school silent auction, and I want to buy this cool painted lemonade stand. Okay, I might be able to help you with your lemonade stand. Okay, Daddy, well, this is your choice. You can either lend me $100 for 5 years till I graduate high school and I get rid of my lemonade stand. Lend me $100 and I will pay you 6% interest a year, okay? And if anything happens, and my lemonade business doesn't work out, I'll sell the lemonade stand and you'll definitely get your $100 back. You're guaranteed to get your $100 back, okay? Or, Daddy, if you don't like that deal, you can have part of my business for $100. For $100, you can have a quarter of my business. And when I make profits on selling my lemonade, you can get a quarter of all the profits I sell. But if I don't sell anything and my business goes bankrupt, then you're not going to get your $100 back. So, now, I didn't want to do this, but I sent it out to my buddies, Spendthrift Sam and Sensible Susie. And Spendthrift Sam, he wanted to buy a piece of the business for $100, and Sensible Susie, she wanted to loan my daughter $100. So to be honest, neither one thing is better, nor is the other necessarily better. They're two different kinds of investment. One is a bond. One is a loan to a company, which is a bond, which is traditionally safer than an equity, okay? The other one, where you own part of the business, is an equity. That's what a stock is. If anybody, a lot of people don't realize, I asked my wife, partly why I thought about this the other day, is I said to my wife, honey, what's a bond? And she said, oh, it's something that the government issues, and it's safe as houses. Well, that's partly true. The government does issue bonds, but so do companies. A lot of people don't realize that actually companies are a huge part of the bond market. I believe they actually issue more bonds than they do issue stock. And bonds are traditionally, because the company is obligated to pay you back your money as long as it's solvent, and in fact you get paid back the money before the share owners do. Okay? And also because it has this predictable guaranteed income stream, it means that the prices of bonds stay more stable. Whereas equities, depending on how much money my lemonade stand makes, I can either choose to pay you more or less money. If my lemonade stand doesn't make any money this year, I may not pay you anything. If I want to increase the growth of my lemonade stand and buy a lot more lemonade stands, and I become a growth lemonade stand company, I may not pay you any money on your ownership this year, and I plow it all back in to buying more lemonade stands. Now, I might need your agreement to do that. You have to agree. Yes, okay, my daughter's Elizabeth. Okay, Elizabeth, we agree. You can go and make more lemonade stands instead of paying us back money. So the reason why I explain this to you is because it's just to clarify what a bond is and what a stock is, and for people to understand that yes, traditionally bonds are safer than stocks, but traditionally over the long term, stocks end up making more money than bonds, because as the economy has grown, as businesses make more money. And on top of that, unfortunately, interest rates have fallen for the last 30 years. And that, in fact, first of all, I'll tell you that, so that the not so funny thing about stocks is that you can lose all your money. And the funny thing about bonds is that as interest rates go down, bond prices increase, which seemed baffling to me when I did Economics 101. My first day, I go into the economics lecture, and the professor starts talking about bonds, and he says, yeah, so when interest rates go up, bonds go down. And I thought, why would I pay more for a bond that is paying me less money? Does anybody here know why bonds go down when interest rates go up?
They equalize each other. So, I mean,
Yes,
debt
yes.
usually drops when interest rates go up, and that's where your balance comes out.
Right, so what happens is if I already have a bond, and if I have a bond that's cost me £1,000, $1,000, it's cost me $1,000, and it's paying me for a coupon of $40 a year. So let's rub this off. Okay, so I bought a government bond. Actually, I'm gonna say it's paying me $60. $60, what's called a coupon. And a coupon is fixed. The coupon doesn't change once that bond is owed, or else it's considered a default. Whoever gives it to you, in this case the government, is a 10-year bond, so they've guaranteed to pay me $60 a year for 10 years, and then they'll give me my $1,000 back, okay? And at the time they issue this, interest rates were at 6%, okay? Then, interest rates, 5 years later, interest rates dropped to 3%. And I want to sell my bond. So, I want to sell my bond, and right now, someone can buy a bond for $1,000, and it only gets a $30 coupon. Well, if I want to sell my bond, they're going to get $60 off my bond, so they're going to be willing to pay me maybe almost double what they would pay the government for a $60 bond, because this, if it rises to $2,000, we'll be paying the same percentage, we'll be paying 3%. So that is why bonds go up when interest rates fall. So now, as you may know, or have noticed last year, interest rates finally started rising. And the bond market, for one of the first times in history, had a negative return, about 2%. Now, since 1981, 1982, when interest rates were around 18%, and they dropped to 1.4%, they hit 1.4%. This is a 10-year, sorry, the 10-year treasury dropped to 1.4. I hit it a couple of times last year and then the year before. You can't get much lower. I mean, Japan has, and maybe we will again if we drop into a terrible recession, but chances are interest rates will start going up. Well, all of asset prices, including housing and property and stocks and bonds, have all had this huge tailwind. Well, that is likely to change. And it may be that stocks and property may be able to withstand that headwind, but it's very difficult for bond prices to withstand that headwind, especially if interest rates rise fast because their prices fall. Now, if it happens over a very long time, then the coupon that you're getting, the interest you're getting for the bond, like if you're getting 6% interest a year, 6% interest a year, and the prices are declining 2%, well, you're still making 4% a year. So then you're still okay. And definitely people, if you have retirement accounts and you're having a balanced portfolio, you shouldn't ignore bonds, because if you ignore bonds, when the sky falls and the world comes to an end and the equity market craters, bond prices are the one thing that will go up when equity prices fall. And you'll be very glad that you had that bit of stability. So it definitely helps, and it'll stop you from bailing out wholesale and selling out at the bottom of the market. Okay, so that's, that brings me to the next thing. As you've probably heard, the holy grail of investing is diversification. So let me tell you a little story that I was about 8 years old, and I must have been walking along to school, and it's one of the only conversations I remember with my father when I was a child. And he didn't talk much, and he must have really had nothing to say, because he started talking to me about diversified portfolios, which now that I have, had 8-year-old kids, 8-year-old boys and then an 8-year-old girl, the idea that my father was talking to me about how to make a diversified portfolio is somewhat strange to me. But I must have been a very strange 8-year-old because I was absolutely fascinated as he told me that I should hold at least 8 stocks. And actually you should hold more, but we'll say at least 8 stocks to have, and they should be in 8 different industries, if possible, to have a diversified portfolio. He didn't mention bonds at the time, which you should also include. Well, my father sadly did not take his own advice. 3 years later, my family moved abroad, and for safety, my father put everything into one company that he regarded as safe as houses. And I'm not allowed to mention specific companies, I won't tell you what it is. But I will say that it made a pioneering jet engine at the time, and it was an incredibly established British company, and he really felt that it was as safe as houses. And unfortunately, it was selling to the US, and it was making all its sales to Lockheed in the US, and it was a very successful jet engine company. But the US put in a restriction whereby they couldn't bring their money back to England. The money was locked up. All their profits were locked up in the US. Meanwhile, all their costs were happening in England. And by the time this company, and it was a bad management decision, it was bad, just a stupid accounting decision by some financial guy at the company for structuring things in this way. By the time they brought the money back, the exchange rate had changed, and the company was bankrupt, was insolvent. And my father lost his life savings. So I was fortunate to have a lot of lessons like that when I was a kid, which maybe is what made me particularly sensitive to this industry. So it is often said, you get rich, you get rich by concentration, okay? And you stay rich with diversification. And it can be true if you concentrate on something and it happens to do well, be it owning one particular real estate building or be it owning one particular stock. Hey, again, I can't mention names, but you all know stocks that if you had held them for 30 years and been in them at the beginning in a big way, you would have done well. But as my father's experience, the more likely case is you become very poor through concentration. So it's much better to do like Sensible Susie and do the safe thing over time. So you say to me, well, Adam, okay, all this up and down, well, my financial advisor talks about investments with guarantees. What about a guarantee? I don't want all this up and down thing. Which brings me to fixed annuities. And again, the lawyers don't allow me to talk really much about this area. I will just say that with annuities, and they do have certain guarantees, they're guaranteed by the company for what that is worth. And to me, anything guaranteed, I don't even believe in a guarantee by the United States government, to be honest, which is what United States Treasuries, that everybody is regarded as a risk-free investment. In all of the models that the economists build, traditionally it was considered as a risk-free investment. So when we came to the crash, all those models started going out of the window because suddenly people were starting to think, well, maybe the US government treasury wasn't so risk-free after all. Personally, I don't think anything is guaranteed and nothing is risk-free. So be wary of those kind of statements. Now, getting back to fixed annuities, which are guaranteed by the company that issues them, and if the company's still around in 30 years when you retire, well, that's great, and a lot of them will be. They have a lot of fees, and we talked earlier about you want to try to reduce your fees and your expenses as much as possible, okay? However, they do also have a certain kind of insurance product in them that they are trying to give you a guarantee. Oftentimes they are endeavoring to promise to pay you a certain amount of money. And for that, again, you pay an insurance fee, effectively, that's built in that you may never see. But, you know, there's no such thing as a free lunch, except for here. There's a lot more I'd love to say, but again, my hands are somewhat tied, so I will move on. And anybody who has any questions about them, feel free to give me a call. I'll give you my business cards later. Okay, but there's something even better than guarantees. and this is free money. Now, this may not apply to anybody in this room, but it might apply to your spouses, or your moms, or your dads, or your children, okay? So what is free money? So, Spendthrift Sam finally decides to start saving. And he comes along and he sees me, and I look into his financial life, and there is free money. And I turn to Sam and I say, Sam, look at all this free money you've been ignoring. And he looks at me and says, Adam, I never ignore free money. I need all the money I can make for my payment on my Ferrari and the girls I'm taking out to the restaurants. What do you mean free money that I'm ignoring? Well, Sam, you have a matching 401k that your employer is giving you, and you're not contributing to it. He's like, oh, it's just 4%. If I put in $100, yeah, they give me $4 back. What's the big deal? I don't want to waste out on that. I've got my Ferrari payment to make. And I'm like, no, Sam. If your salary is $100,000 and you put in $4,000, they'll match the $4,000. They'll match you up to 4% of your salary. If you've got a $200,000 salary and you put in $8,000, they'll match up to $8,000. So that's thousands of dollars you're leaving on the table every year. And I see people do this, or I hear people do this all the time. Oftentimes because these kind of plans are often with the government, or maybe they're teachers or something, and maybe the people aren't earning a lot of money and they think they simply can't do it. But they don't realize that is their money, that is their salary. And if they don't contribute to that 401k, they're not getting their own salary back. They should, if you're paying off your home equity loan, they would be better to focus on contributing to that 401k before paying down their home equity loan. They should definitely seek, because anybody who has a matching 401k and can't figure out a way to contribute it should seek a financial advisor to try to find a good financial planner to try to find a way to do it. And again, I could go more into that, but I won't. But if you have relatives who have such, yeah.
Can people in real estate have 401ks?
No,
Or
Have to be W-2.
unless you have a W-2 from another.
You know what? You can.
You can have
You
401, but no one's matching it.
No one's going to match it, but you can have.
You're 1099, so.
Yeah, you could.
Roth IRA.
Yeah.
Roth IRA is good.
Yeah.
What's the morality of that matching money where you are not self-directing, you're having the company Nordstrom's. My daughter's at Nordstrom.
Okay.
I bullied her into maximum contribution.
Right.
They take the money, they're buying, she's not self-directing it, I don't have the knowledge to. They're letting the company that handles it, the Nordstrom, do it. They are so heavily loaded in Nordstrom stock.
Right.
Is that okay, or is that kind of not kosher?
Right. Yeah, there are a lot of rules around that.
They're like 60% in their own different
Right.
types of stocks.
Yeah, the SEC is trying to start clamping down on that, so the rules have definitely tightened up around it. But if you sent me the particular situation and I could look into it, but obviously I'm sure that they are going to the letter, that they're applying the letter of the law.
Yeah, they are, and they're doing well, so it's like a good thing, but I
Right.
looked at it, and I just by looking at things, wow, they're really heavily loaded over
And
here.
you know what you may find, it is that after 5 years or a certain amount of time, she can sell out of it, and that's what she needs to do, is to diversify as soon as she can. And getting back to the 401ks for you guys, and actually this is something I was going to talk about later, there is a thing called a solo 401k that I favor, a solo 401k that I favor over, for instance, a SEP that you could also do. But I'll get to that in a bit. So this is also going to apply to what I'm about to say. Also applies to that. So Spendthrift is so excited by finding this matching money that he tells his sister, Sensible Susie, to run in and see me. She comes in and she's all excited. This is when she's about 25 years old, we'll say. She's all excited, or maybe she's 26 or 27. She's all excited that, yes, I'm contributing to my 401k, and my CPA's company, they have a 401k plan. But there's no match, okay? There's no match, but she's contributing to anyway. Well, as it so happens, Susie's actually quite young, and she's not that well paid by her CPA company. and she's really paying no taxes. So she's in a very low federal, maybe she's in the 15% tax bracket, okay? So she is getting 50% tax deduction, but by the time she retires, she might be quite affluent, and she'll be withdrawing money out of that 401k at maybe 28%, 33%. Well, that is a no-brainer of what not to do. Susie is not being so sensible after all, okay? So don't think that just because, again, if you've got kids that are contributing to, if they're not getting a match, just to, it isn't, sorry?
I'm just saying, my son doesn't get a match, but he's making a good, he's a software engineer.
Oh, right. I mean, if someone's in the 25% tax bracket, then fine. But if they're in the 15% tax bracket, I would think twice about funneling lots of money into a 401k, except for the fact that it's encouraging them to save. If it's encouraging them to save, do it.
You can do that in a Roth IRA too.
Yes, that's what I'm going to get to. So the thing that these people should be doing is contributing to a Roth 401k. All right. Oh, that's right. Yeah, you can do it into a Roth IRA, but you can also, most companies that have 401ks, in fact, have now also have Roth 401ks. Now, what a Roth means is that you don't get the tax deduction, but you put it into the Roth 401k or the Roth IRA, and it grows free of tax, and when you take it out, you pay no tax. So if you're only paying 15% tax or 10% tax, like let's say you're a realtor, and you've got so many write-offs from your own business that you hardly pay any tax at all. Okay, maybe you've got kids in college and you've got a ton of write-offs, and you've got all the college credits and you're paying no federal tax. Well, then you want to be contributing to a Roth 401k or a Roth IRA, and because you're not getting a tax deduction, but you don't need it. But when you pull that money out in retirement, and you may be in a higher tax bracket, it'll come out completely tax-free, assuming that the tax laws don't change.
What's the earning cap?
What's that?
What is
Oh,
the earning cap?
Right, yeah, there is, yeah, it's about, for the Roth, actually, no, there's no earning cap for a Roth 401k. But for a Roth IRA, there is an earning cap of, I think it's around 180,000. But talk to your CPA about it. About all of this stuff, you need to talk to your CPAs about what's right for your particular case. I'm just throwing out ideas. Oftentimes CPAs they're so focused on doing taxes, they don't come up with the ideas of how to save your taxes or how you, and oftentimes, to be honest, they're not even so familiar with all of the structures. But if you suggest an idea to them, they will at least research and get back to you. So I guess while we're on it, I'll talk then now about one thing that I do particularly like, which is the Roth solo 401k. Either way, the solo 401k. In some ways, it's similar to a SEP. Most CPAs put people into a SEP IRA, which is a simple form of IRA, and enables you to put away, if you're self-employed, 20% of your net income, up to about, I think the limit is around $51,000 this year, okay? Now, why I like the solo 401k is because you can stuff in the 20% for the employer hat. A solo means single person, self-employed person's IRA, solo 401k, okay? So you have two hats. You have your employer hat, and you can contribute 20% of your income as your employer hat, which is also, I believe, but check with your CPA, before Social Security taxes. Okay, so it's free of those taxes too. And then you can also stuff $17,500 in as your employee contribution, or indeed up to $23,000. I think it's $23,500 if you're over 50. Okay, so another good thing is, let's say you've got so many write-offs as a realtor this year. Once again, that you managed to get down your declared income, and I've seen people's taxes, people who earn a lot of money, and well, I think they have CPAs I don't necessarily agree with, but these people write off so much that they end up, declaring $23,000. I've seen a guy earn hundreds of thousands of dollars a year and get the making work credit pay, make work pay credit.
EIC.
What's that?
EIC.
Yes, yeah. Yeah.
Earned income.
Yeah. And I mean, either the CPA or this guy's going to end up in jail, so I don't advise doing it. Maybe both. By the way, on that note, if your CPA does something wrong on your taxes or does something blatantly wrong, you're still responsible. Don't think, well, my CPA is going to go to jail. It would be you. So anyway, however, if let's say legitimately you have all these write-offs and you're down to 23,000 declared income and you're 50 years old and you have a spouse who earns a bunch of income, you could stuff your entire 23,000 into a solo 401k, okay? You couldn't do that into a SEP. You could only stuff 20,000 into the SEP, okay? So you could either choose,
Self-employed.
yeah, I think is it self-employed pension or is it simple something pension? It's self-employed pension. Yeah. So I don't use SEPs anymore, so yeah, I tend to use solo 401ks. Yeah.
What's the difference between an IRA and a 401?
A 401k is an employer-sponsored retirement plan. It's sponsored by your employer. It can be sponsored by you as your own employer. Okay, I mean, if you're not self-employed, and if your employer doesn't have a 401k, you can't get a 401k. But if you're self-employed, you can choose to have your own solo 401k, or if your employer has a 401k, you can have it. But anybody can have an IRA. Anybody can contribute to an IRA. Again, there are lots of rules around that. It's not always worth doing. Personally, I would generally advocate for those who can, contributing to a Roth IRA. Well, you can contribute to the IRA if it's deductible. If it's not deductible, I would not contribute to a non-deductible IRA, okay, which I've seen a lot of people do. If you can, contribute to a Roth IRA. Or, again, if you're above the limits to contribute to a Roth IRA these days, you can contribute to a deductible IRA and convert it immediately into a Roth IRA. Because there's no limit, there's no wealth, there are no income limits, which is a loophole in converting a regular IRA. So that into a Roth IRA. So the one time, again, you need to talk to your CPA because there are things you could get wrong, but if you don't have any IRA savings, you could contribute to a non-deductible IRA and convert it the next day to a Roth. Okay, so anybody can actually basically contribute to a Roth IRA. Like my wife earns $100,000, okay? But if she stopped working and she just kind of supported me so that I could just focus on my work, I could probably make at least another $100,000 a year. And we would pay, we would pay, we would save $15,000 a year on Social Security taxes right off the bat, right? Because the thing about these taxes is that you're pretty much paying them on the first dollar. Even somebody who only earns $1,000 a year pays that 53%. So we're just about to finish, we'll run out of time. So I'll just say one last thing that is maybe the biggest lesson of all, of what I call bubble mania. So in 1563, the tulip was introduced from Turkey to Holland. About a year later, it got infected with a virus called the mosaic virus. And these beautiful striations of color and varieties started appearing on the tulips, and you got all these different varieties. And people started going nuts for these things. And as they did, the prices increased. And then the garden centers of the time, they couldn't get enough of the things, and as growing season came around and they started trying to acquire more, and the price went up even more. It took about 2 or 3 years, but eventually the price of one tulip became worth, one tulip was getting traded for an estate. A tulip, a particularly priced tulip, could get exchanged for a whole estate, traded for an estate, okay? Then at the top, some people decide to start taking their money. And also, people discovered how to grow more tulips. So guess what happened? that tulip went back down in price to the price of an onion. So it ruined the Dutch economy for many years. It went into a deep recession for about 10 or 20 years afterwards. Now, strangely, people didn't learn their lesson from that. About 100 years later, the South Sea bubble happened in England. And a similar bubble based on a trading company, a fictitious trading company backed by the government, trading South American land when Britain didn't own any South American land. It was actually all owned by Spain, but whatever, the South Sea Bubble Company, the South Sea Company was trading land in South America. Again, the price went through the roof. One of the first joint stock companies, actually. So Isaac Newton, one of the most considered maybe the brightest man in the world at the time, and the father of modern physics, was in and out of the South Sea bubble as it went up. He went in and out 7 times. He figured that something was wrong, and he didn't want to lose all his money. But guess where he was when the bubble burst? In at the top. He lost like $24 million. Again, his entire net worth evaporated overnight. He later said that he could calculate the movement of planets, but not the madness of men. And true. The amazing thing is that we see these things happen time and time again. As Warren Buffett has said, if you want to know how to get rich, come in, close the doors. Be fearful when others are greedy. Be greedy when others are fearful. That when blood is on the streets, in the equity market or the housing market or whatever, is the time to buy. When everybody seems like they're making money, and you can do no wrong, and your neighbor is making money, everybody is jumping on the train. Guess what? The train has probably already left the station. So be it gold or Bitcoin or the property market at times, or the equity market. Just bear those words of Warren Buffett in mind. And then when the world falls, the sky falls and the world seems to be at an end, then think how you would if you go to the market one day, if you go to your favorite designer store and you buy an amazing designer dress and you go home, and then the next day you hear that everything at your favorite store has gone on sale for 50%. Or at my favorite store, the only time I ever go there, Fred Siegel's, I go there when everything is like 60 to 75% off. Okay? And I am jumping for joy. I mean, true, I never buy full price there, but even if I did, and then I heard there's a 75% off sale, I'm running down to Fred Siegel's. I'm buying me all the clothes I can for the next 5 years. Okay? I'm happy. But when prices, I'm not allowed to say go on sale, so I will say when prices decline in the equity market dramatically, then especially for people, most of the people in this room who are not retired, then be excited, because this is a time to start investing and loading up. And it may go down further in price, but keep buying and just be in. Know that you're going to be in for the long haul. So yes, as again, to quote Warren Buffett, who has said, profit from the folly of others. Don't participate in it. And if you do that and you save your $5 a day, then maybe at age 65, you can be sexy too. And that's it.
Thank you.